War in the Middle East, an AI bubble that might be popping, oil above $112 a barrel, and your portfolio is doing this. The real question everyone's asking right now, should I buy the dip, or is this the beginning of something worse? I looked into it, and the answer is not what I expected. Okay, real quick, because I know you don't have the time for a 20-minute explainer, so let me make this simple. There are three things driving the market down right now, and they are all happening at the same time, which is kind of insane. Number one, Iran. The US-Iran conflict escalated this month. Oil is now up above $112 a barrel, and when oil goes up, everything goes up. Food, transportation, manufacturing, and even inflation goes up. The Fed can't cut rates, and investors hate that. Number two, AI bubble fears. Google just dropped a new algorithm called TurboQuant that could massively reduce how much memory AI models need. Sound cool, right? Except Micron, one of the biggest chip manufacturers, dropped 20% in 5 days. Because of it, investors are starting to ask, are we paying too much for AI companies? Now, the OECD just projected 4.2% inflation for the US in 2026. That's almost double what the Fed was targeting. Now, high inflation, slow growth, that's the worst combo possible for stocks. Now, a 4.2% statistic may not sound like a lot to you, but I'm from Argentina. Argentina had over 200% inflation in a single year. And I don't mean that as a statistic, I mean I lived it. I watched it happen. Here's how you actually feel it. You go to the supermarket today, you buy something, come back tomorrow, same store, same shelf, and it costs way more. And I know what you're thinking because I've literally seen tourists think that they were getting scammed. They weren't getting scammed. That was just normal Tuesday in Argentina. So that was in 2023. Now we're good, I guess. So when the OECD says 4.2% and the economists start talking about stagflation, I'm not reading from a textbook. I know exactly what the early signs are. And the US is showing some of them. Now, option 1, panic and sell. This is what most people do, but almost every single time in history it has proven to be the wrong move. Last year, the S&P dropped hard when the Trump tariff war started. People sold, then the index finished up 2025 up 16%. People sold, locked in their losses, and missed the recovery. Option 2, do nothing. If you're invested long term, that's actually valid. You don't need to do anything. Time is your best tool here. Option 3, buy the dip strategically. And this is where it gets interesting because not all dips are equal and not all dips should be bought. And here's what I learned personally. I'm not going all in right now because when there's geopolitical conflict driving the sell-off, Iran, oil, and real-world stuff, the bottom is harder to call. It's not just sentiment. There's a real variable outside of the market's control. But I am continuing to buy as it gets cheaper. Now your play is to hold your position and continue adding more of these quality companies as they get cheaper and cheaper. See ya. Maybe consider subscribing.